Good morning, everybody. This is Prehn with InsMark. I think you're going to really enjoy today's presentation. We are going to be focusing on using a new product called CHEIFS, which is a home equity product to fund the tax on a Roth conversion. I think it's going to be one of the most exciting strategies you've seen in a long time. Today, we've got Craig Korn, who's one of the co-founders of Cornerstone Financial, and they're the ones that created this new CHEIFS home equity product that we think is extremely interesting. And just in a minute, he's going to kind of explain to you sort of the genesis of the CHEIFS product and how they created it and why, what market segment they were trying to service. The other speaker we have today is Chris Jacob, and you've probably seen Chris's webinars in the past with us. Chris is one of the 2 or 3 most knowledgeable life producers on our Wealthy and Wise software product. And he's able to design cases and do things with our product that we didn't even think it could do. So he's the one that's going to kind of walk us through how to use Wealthy and Wise to show sort of the before, where someone's planning to do a Roth conversion and fund the tax on their own, versus sort of scenario 2, where they use the CHEIFS home equity product to fund the Roth taxes. And you'll see the difference to the client is incredible in terms of liquidity and income availability. It's just a far better structure. So with that said, before I hand it over to Craig to kind of tell you a little bit more about the CHEIFS product, I want to just take a second and explain to you sort of how we got involved in this and why we think it's so significant to you. Let me bring up the, trying to find my flowchart here. Now I've got the flowchart up. Everybody seeing that okay?
Yes,
Great,
sir.
great. So up until now, there really hasn't been a great way of accessing home equity for a certain type of client. There's lots of products like reverse mortgages and shared appreciation contracts that work great for people that are desperate for liquidity. Someone who's house rich and cash poor, reverse mortgage or shared appreciation contract, or maybe a short-term liquidity need, less than 10 years, then a HELOC can make some sense. If you have proof of income, you can cover the underwriting on those, which is not always easy. What no one has done up until now is given the A credit, mass affluent or high net worth client a reasonable product to access home equity. When I say reasonable, the reason none of the current products really work is the costs are just too high. So someone who doesn't need the liquidity isn't going to accept a product like reverse mortgage that it's just too expensive because they don't have to do it. So what Cornerstone has done is they've come out with a product that is for the mass affluent high net worth client, where they don't need liquidity, but they would access their home equity if you can show them how doing that will improve their overall financial plan. And so that's what Cornerstone has built. And when they showed it to us, we instantly understood the gravity of this, because there's $35 trillion of home equity. 41% of all homes in the United States have no debt. So you have a lot of your existing clients that have lots of home equity. They just don't need liquidity. And so if you could show them a low-cost product to access that home equity, it's a very big deal. And the reason it is because that liquidity, which is sort of found liquidity, they're not getting it out of selling mutual funds or getting it from the checking account or selling a rental property to create cash for paying the tax on a Roth conversion. Now all of a sudden you're able to access liquidity for that mass affluent or high net worth client. And now you can use that liquidity. And in Wealthy Wise, you showed us, you show the status quo plan. You just keep going the way you're going. That's scenario 1. But in scenario 2, you can now use that home equity liquidity to fund, as you can see in the flowchart, life insurance, retirement plans, mutual funds, long-term care insurance, deferred annuities. Today, you're going to look at how it can fund Roth conversion tax. But the potential is really exciting. And one of the great things you're going to see today both when Craig kind of explains the product and then when we actually go through this sample case of the client funding the Roth tax on from their checking account or their mutual fund, liquidating something versus accessing home equity to do it, what you're going to see is that this now creates a tremendous source of liquidity for really funding anything that you and your client think makes sense, because the cost structure makes sense for the 8 credit client. So with that, I'm going to leave this flow chart up. Craig, I'd like you, if you would, to talk a little bit about Cornerstone and CHEIFS. And then everybody, once Craig is done, we're then going to go over to Chris Jacob and slowly walk you through a case. Again, the scenario 1 where the client funds their own tax, Roth conversion tax, and then scenario 2 where we use the CHEIFS home equity product. I think you're going to be really excited, not just by today and the Roth conversion, but by the potential of using CHEIFS funds to fund any number of insurance or investment products. So Craig, please take it away.
Don, thank you. And thanks to everyone for attending today. Again, my name is Craig Korn. I'm the co-founder of Cornerstone Financing. We are the creator of CHEIFS, otherwise known as converting home equity into financial success. We work with thousands of insurance and financial advisors, and a common question we get is, what are CHEIFS? Here's the simplest way to explain it. CHEIFS is a non-debt home financing solution where Cornerstone purchases a portion of a homeowner's home equity and provides tax-free funds, while the homeowner keeps ownership and control of their home. In essence, your homeowner clients are selling a fraction of their home to Cornerstone, which in many ways is no different than selling a fraction of their investment portfolio in order to create liquidity. For advisors and homeowners who consider CHEIFS, the real value is when CHEIFS are part of a longer-term insurance and investment strategy, because CHEIFS come down significantly over time, approaching an annualized cost of 5 to 6% when we look out 20 plus years. In fact, through the lens of a longer-term strategy, there are very few, if any, more efficient funding solutions than CHEIFS. CHEIFS also provide the ultimate homeowner flexibility. No monthly payments, no maturity, and no prepayment penalties, no impact on credit, ability to use CHEIFS proceeds for any reason. They can be done on a home with an existing mortgage. We certainly don't want you to pay off that 30-year, 3% fixed rate mortgage. It's great liability to hold on to. And of course, we can do it on homes with no mortgages. It can be done on primary residences, secondary residences. If you have a third or fourth vacation property, no big deal. We just don't do them on investment properties. Another common question we get from advisors is, why did you start Cornerstone and create CHEIFS? That's a really exciting question. In 2025, advisors originated over $500 billion of new life insurance, annuity, and long-term care insurance premiums. By definition, that was funded from cash on hand and the liquidation of investment portfolios. Currently, there are $45 trillion of qualified plan assets under management, of which less than 3% have been Roth converted. Why only 3%? Well, because coming up with the funds to pay the Roth conversion taxes is a major constraint against, again, having to come from cash on hand and or liquidation of AUM. That's why we created CHEIFS, to provide professional advisors like yourselves access to over $35 trillion of dormant home equity in the most efficient manner available in the marketplace. Effectively, we've created a third major alternative funding source, home equity through CHEIFS, which allows advisors to source liquidity to fund insurance and investment products for longer and to better serve their homeowner clients. One last but very common question we get from advisors is, who is using CHEIFS and what are they using it for? Well, it's a great question and a very simple answer. Your mass affluent and high net worth clients are using CHEIFS. Here is a typical Chief customer who might look very familiar to you. Late 50s, living in a $2 million home, strong credit, roughly a 740 FICO. 1/3 of the time, they have no mortgage on their property. The other 2/3 of the time, they have a small mortgage. On average, they do a $250,000 Chiefs transaction using the money for the following reasons: purchasing life insurance, annuities, and long-term care, making investments, and funding the taxes on a Roth conversion. You heard that right. In 2025, when we started to originate Chiefs, we hadn't thought about Roth conversions being a catalyst. Well, multiple advisors brought this funding strategy to our attention, and in Q4, we originated several transactions where Chief proceeds were to use to fund the taxes associated with a Roth conversion, and we now have many more in our pipeline. When we discussed Roth conversions with Don and the InsMark team, they immediately saw the power of using home equity through Chiefs to fund Roth conversions and the value associated with allowing more AUM to grow tax-free for longer with no required minimum distributions. The InsMark team helped us model this unique funding strategy within Wealthy and Wise Plus, and we've all concluded that this strategy can be a significant value proposition for advisors and their homeowner clients. So with that, allow me to turn the rest of this webinar over to Chris Jacob and to Don.
Let me say one thing really quick, Chris, before you start. Just two quick things. Craig, thank you. You reminded me of something. That's if we had 10,000 people in the room that were mass affluent or high net worth, meaning when I say mass affluent, I mean they've got some pension money, they've got some mutual fund investments, they have some equity in their home. You're probably talking about a net worth of 2 to 20 million, and then above 20 million, you get your high net worth. That's what we mean. People that and have some liquidity, they're comfortable.
Yep.
Okay, fine. If you took 10,000 people that qualify for mass affluent or high net worth, you put 10,000 people in a room, and you said, how many people have money in a traditional 401k? You're going to get most of the people raising their hands. Okay. For those people that have money in a non-Roth retirement plan, how many of you 10,000 people are concerned that in the next 20 years, 30 years, as you go through your retirement, that the government might increase tax rates to confiscatory levels to target you as that money comes out of those plans? You know how many hands are going to raise? 10,000 hands, except for the people that are asleep. But everyone awake is going to raise their hand. And so the reason Roth conversions matter is because when your clients reach close to retirement age or are already in retirement, they're becoming more and more risk averse. So whether tax rates are going to go up or not going to go up, who knows? They're worried about it. And so, I've had a couple of people say, well, what good is showing a Roth conversion funded with a Chiefs home equity product? That doesn't create a financial product sale. It's like, yeah, you're right. You know what's more important than a financial product sale on this one discussion and transaction helping the client is the overall relationship, to get them conditioned to doing an annual Wealthy and Wise review with you every single year, telling you all about all of their financial assets, what's going on with their retirement, what actually happened with their investments every single year. Because number one, then you're going to have the opportunity to sell them lots of other products. And number two, they're going to want everyone they know to talk to you to do those same Wealthy and Wise analysis for them, to help them make smart decisions in the context of an overall financial plan. So I just wanted to explain the importance of Roth conversions if we can figure out a way to fund the tax to most of your clients that are in the mass affluent and high net worth. Chris, with that, can you go ahead and share your screen, or maybe you already have?
All right. Thanks, Don. Yeah, I've got to tell you that in the 39 years I've been working with InsMark, this is the most exciting thing I've seen come into play. It really is, because as advisors, our goal is, yes, planning, but how do we find the money, right? And this is the best find the money strategy I've ever seen. Before we go into the Wealthy and Wise module, I kind of want to start from the end in the beginning. And to do that, I'm going to have you look at this chart graph. What you're going to see here is we have a couple who want to retire on $150,000 a year adjusted for inflation. They have a current traditional IRA that they would like to convert to a Roth. It's in the amount of $800,000. If you assume a 40% tax bracket on that Roth conversion and they do it all in 1 year, they're going to have to come up with $320,000 from somewhere. And typically that's going to be sacrificing opportunity costs out of a brokerage account, let's say. So I want you to see the difference between the regular Roth conversion where they paid the money out of pocket. Hey, they still, through life expectancy, have $6 million. The green one is where we do the same Roth conversion, but rather than dipping into the equity assets to pay for the conversion tax, we enact a CHEIFS plan that is going to generate that conversion tax money. And the real telling graphic here is, look, same income, right? Look at the difference in their liquid net worth out at age 99. I mean, that's
Chris, let me jump in. I love this. So what you're saying is strategy one is where they had to sell some mutual funds to fund the Roth tax. Strategy two is they didn't. They left everything alone and got the money from the CHEIFS transaction. And by doing that, at age 100, they created a $3 million liquidity and investable assets position versus 586.
Yeah. Would you rather be
And by the way, this is why only 3% of the people are doing Roth conversions. This is why. Because nobody wants to take that hit by paying the tax. And CHEIFS solves that problem. Go ahead, Chris.
Yeah, it's for those of you who are manage money out there. Sometimes maybe a Roth makes sense, but when you look at the hit to their liquid net worth and quite frankly, assets under management, it might make sense in the long run, but it certainly seems that, you know, going to that in liquid assets by paying it out of pocket, people might not feel comfortable with that. So one other one we'll look at is this. What if through the CHEIFS transaction, we convert the same 800,000, but now instead of 150,000 of adjusted gross income, we give them 175. Notice up here, they run out of money. Here they don't. As a matter of fact, they get $1.4 million more in net after-tax spendable income while still having $623,000 of liquid assets at age 99.
Yeah, and everybody don't get stressed that you don't understand the underpinnings of these numbers. We're going to get to that. Well, what Chris is what he's explaining is if we ratchet up the annual income during retirement, which gets 7,099,000 instead of the 5.6, because we structured more income, and you'll see how we do that in a second. Now the impact of getting the Roth tax money from the home equity is that you've got 7 million of after-tax income for the clients instead of 5.6 million, and 623,000 of liquidity at age 100 instead of broke at age 94. No liquidity, broke, which is the plan where they fund the tax by selling existing mutual funds. So this is a big deal. Go ahead, Chris.
Yep. And this is where InsMark is pretty much the only financial planning software I know where you could actually illustrate the efficacy of CHEIFS. And what we're going to do here is, this is status quo. Convert a Roth of $800,000, do it by taking money out. I'm not going to go through every one of these. Let's just look at their cash flow. Okay. They want 150,000 of net after tax. I'm going to blow this up a little for you guys, starting at age 70, which means if you look at this, they need right here assets that can deliver $6 million of net after-tax cash flow. But they also need 320,000 to pay the tax on that $800,000 Roth conversion. Now, they have $1.1 million in equities. and we're going to grow it at 6.5%. Notice where the 320 came from. We took it out of the equities. When it came time for retirement, this column here represents Social Security that they have coming in. That's going to be augmented by distributions from the equity assets first. We'll use those. And then we're going to switch over to the Roth assets to provide the desired income. The good news is, here's joint life expectancy for them. There's no red here. They don't run out of money. That's the good news. Okay.
Hey, Chris, let me stop you for a second. Can you just take a second, go back to the previous screen?
Yep.
What I want to show everybody, close out of this.
Okay.
Go ahead and hit close. What I want to show everybody is this is the status quo case where they funded the Roth tax from their own mutual funds, their own assets. And I want you just to slowly walk through each of the tabs. WealthyWise is so unbelievably easy to use. People make it so more difficult than it is. Just show them the desired cash flow. Let's just walk through slowly each of the tabs so they see the underpinning of what you just showed. You see where the tab where it says preliminary data, desired cash flow, expected cash flow. Show them the case. Okay, so as we went into WealthyWise, the first thing we wanted to ask the client was, well, what do you want during retirement? So click schedule, Chris. The client said, look, when we retire, when we're 70, we want 150,000 a year indexed. And go ahead, Chris, and walk them through kind of each of the tabs and how we built this initial status quo case.
So what we did is we put in 150,000 starting at 70. And then after that, we adjusted it for 2% inflation. So this is the inflation adjusted to maintain the standard of living of $150,000 at their age 70. Pretty easy. If they have other expenses, you can definitely other places to put them. Where's the money going to come from? Well, in their case, the only place we have money coming in is Social Security. I did not index it for inflation because usually Medicare A and B starts to eat all that. So you could if you want. Sure. You just got 35 grand going through all the way out.
Yep.
Now their retirement plan assets. Notice this is their traditional IRA. $800,000. You can use whatever yield you want, but I put in 6.5 and I put in a 1% management fee. Okay. They want to convert that. So this box wasn't checked before. I checked this box and just labeled it Roth conversion. Also at 6.5, also with the 1% management fee. You go over here and click this conversion box. Do you want to do it over a period of years? Now we're just going to do it in 1 year. Okay. And notice where it says pay tax from, you get to pick and choose where it comes from. I said, okay,
great.
Only place that's going to have it is the
broker.
Very
easy. Yep.
So let's look at their liquid assets. I check the box here. I mean, you can choose different types, but this is a brokerage account, so we're going to put it in as equity. They got $1.1 million currently with a cost basis of 800,000. The 2 is assumed at 6.5, and also with a 1% management fee. All right. You can get into all the intricacies of whether how much of it's short-term, long-term. I just said it's 100% long-term capital gains growth. Now, what they also have is a home that in this case is paid for in the amount of $1.5 million. And we're going to assume a 2% growth rate.
Beautiful.
They don't have any of these other things here. We're not going to look at them right now.
Yeah. And Chris, now go to your cash flow report. So click on your report selections and let's look at the cash flow analysis now. No, not that.
You want expected
cash flow analysis. Fourth one down. That one. And then thank you. So what he's just shown you, everybody, I just want to be clear. What he just showed you is replicating what the client said when they want to retire and how much income they wanted and what their current pension plan balance was. That took 5 minutes. That is incredibly straightforward and simple. And the cash flow analysis is now showing you what they just told us, which is they need $320,000 to fund the Roth tax, assuming they do it on their own, and then $150,000 a year. Chris, continue. Go ahead.
Sure. Now, this is like the founder of InsMark said, people, real wealth is all about sustainable cash flow. And I think the best thing you can do for somebody is to prove, hey, look, what you're doing, you're not going to run out. But can we put you in a better position, especially vis-a-vis liquid assets for the future. Okay. So
Yes.
if you look, there's a report here that says summary of liquid assets. And when I click
Right.
that, you're going to see that the blue is the Roth net of the distributions in order to generate the 150,000 adjusted for inflation at 2% desired income. And these are the remaining equity assets as they're being drawn down upon to A, fund the conversion tax, and B, fund the income.
And
So,
everybody remember, this case is the one where the client does the Roth conversion now and funds it themselves by selling mutual funds. They get that 320,000 by selling the mutual funds. That's what you're looking at, and they end up with 586,000 liquidity at age 99 or whatever it is.
yep,
That's sort of if they do it without the CHEIFS strategy. I just want to make sure everybody's locking in on that.
right.
Okay.
Okay. So we're done with this one. I'm not going to show you how the watch is made, but in order to generate this next one, I just cloned it. I just said, copy this. Okay. And then we did make one fundamental change in here over and above the first one. We're still going to convert the Roth, okay, to it from an 800,000 traditional to a Roth. Everything else is the same. We've got the same expected cash flow from Social Security. We've got the same brokerage account. What is going to change is we're going to check this button here, mark that one where it says include CHEIFS plan. And then we're going to go to add details. Craig or Don, I'll let you take over this one.
Yeah, let me kind of explain. So what we did with Wealthy and Wise Plus, we kind of merged Wealthy and Wise and Wealthy and Wise Advanced. There's now just one product called Wealthy and Wise Plus. And it used to cost a couple grand and $60 a month. We're waiving for the foreseeable future. We're waiving the $2,000. Now it's just $60 a month, at least for now. We may bring the upfront feedback later, but for now it's $60 a month, and so it's incredibly affordable now. And we also added the algorithms to be able to mirror the CHEIFS home equity product. What does that mean? That means that for a client, in this case, with a $1.5 million home, the CHEIFS program designed for A credits can advance in this particular case there's no existing first or second mortgage. We were able to advance 326,437. You can see up there in desired cash up on the top. It automatically calculates that because it understands the CHEIFS algorithm and loan program. Then, and here's the key point, and this is everything. Once you understand this, you will totally understand why CHEIFS makes sense for A credits, certain types of clients. The CHEIFS repayment, so they advanced the 326,000. The CHEIFS repayment is the lesser of 12.99% annual interest rate effective cost, or 50% of the future value of the property. It's capped at that. So, and you'll see in column 6, the early years, it's like, well, why is that not 12.99? Why is it 15.4? Well, the answer is because there's some, you got to get an appraisal and there's some initial costs. Let's not get stuck on that. But I want you to go down to year 20. And I want you to show you something that you're going to really find interesting. In year 20, the effective cost of funds on the 326,000 is 6.33%. Well, how can that be if you're charging 12.99? The answer is it's the lesser of 12.99, or it's a lesser of column 3 or 4. Column 4 is the 12.99, but column 3 is 50% of the future value of the home. So in year 20, the future value of the home is 2.2 million. They cap at 1.1 million. See, the 12.99 has gone to 3.8 million. So where CHEIFS is an incredible product in terms of acceptable cost of funds over time is where you have clients that are not desperate for liquidity and they're in their forever home. Meaning, this is where their friends are. They belong to the country club. The kids live in the area. They might buy a rental home in Maui, but they're not moving to Nebraska. They're staying here for the foreseeable future. In those circumstances where either the husband or the wife, or if it's a single person, thinks they're going to be there at least 10 or 15 years, There's nothing that competes with CHEIFS in terms of low cost access to home equity. And so I think we lost your screen, Chris.
You lost it?
Yeah, I saw that Joel Baker was sharing his screen. Tony, can you give control back to Chris? There we go. Okay, so again, it's for suitable clients that are, I mean, if a client is only has a year or two to live, they shouldn't do CHEIFS because they're not going to be in the home. But one other comment I want to make. So let's go over 30 years because these clients are in their mid 50s. If you ask these clients, what's the likelihood one of you is going to be in this home in 30 years? Most would say, well, I think it's pretty likely one of us will be here. We hope, God willing. And so if we look at year 30, look at the cost of funds, 4.87%. 4.87%. And here's the other thing I would tell you. It's not like comparing a 4.87% to a HELOC rate, which is 8 or 8.5% today. Why? Because the HELOC money has to be repaid over the next 10 or 20 years. It's a loan that the bank wants the money back. This 4.87%, the correct comparison is to a reverse mortgage or a shared appreciation contract because the terms of the CHEIFS product work very similarly, meaning that 4.87 doesn't have to be paid by the clients until they sell the home, which presumably is when they die or when they're at an advanced age where they're going to be going to a nursing home or what have you. So it's a 4.87, but it's a better 4.87 because it's being paid largely by the estate. And so that's a great trade to have more income, more flexibility, more access to liquidity now and during retirement, and then have the payment ultimately come from the sale of a house, which is largely an estate issue. So in any event, I do want to show one other thing before we move off of this. But with the cap at 50% of the value of the home, and they can structure it. I'm trying to simplify this. They can structure it so it's not 50%, so it's some other percentage. When you talk to Cornerstone, you can get into all those details, and there's different programs, and that's all fine. But the basic concept is for clients that are in their forever homes, they're going to be there 10, 15 years or more. This is a monster in terms of helping clients source liquidity for things that they will improve their financial plan, improve their lifestyle, more income, and so on. So one last thing I wanted to show you, we thought it would be kind of interesting. We wanted to compare the CHEIFS product to a HELOC and a reverse mortgage. And so can you cancel out of that for a second, Chris? I just want to show them over on the right. So over on the right, you can click the checkbox for, yeah, I want to compare this to a HELOC. And yeah, I want to compare this to a reverse mortgage. Click on that. Okay. Now, what I want you to do is click on Edit Details for the HELOC. And typically the way HELOCs work is they have a draw period, typically for 10 years, where it's interest only. And then they have a repayment period, typically for the next 10 years, so years 10 through 20, where you have a principal and interest payment. It's typically over a 30-year amortization, which creates a balloon payment at the end of the 20-year repayment period. So they don't all work like that. That's how most of them work. So let's click OK. So we're mirroring that. We're only going to spend a second on this, guys. And then go down to reverse mortgage and look at the edit details. This is not a reverse mortgage class. The fees are correct. They're pretty fixed. We've put in the fees, you put in the interest rate, fine. Again, we can get into the detail of the forensic analysis of whether we've modeled the reverse mortgage correctly later. Click OK. And then what I want you to do, Chris, is click OK. And let's go back to the report selections and let's just look at the comparison graph. Yeah, there it is. That's it. Good quick preview and advance to the next page so they can just see the graph. I just want you all to see the impact of this. So what you're looking at here is the red line is the HELOC, which really doesn't even belong on the graph because you got to pay all the money back during retirement. So it's not accomplishing what a reverse mortgage or a CHEIFS or a shared appreciation contract is doing, where you effectively have no payments until the home is sold, presumably the very end of life. The real comparison is the purple line, which is the reverse mortgage, compared to the brown line, which is the CHEIFS. And that is a massive difference in terms of essentially the entire value of the home is lost to the estate instead of half of the value of the home. I mean, which is a huge deal because the home is going to be one of their most important, largest assets. One last thing I want to show, because there was a great question that came up and said, well, what about the appreciation on the home and what's going on? Hit close, because I want to address that. Hit close, and I want you to go back to liabilities, and I want you to click on, stop right here. I'm sorry. One of the smartest people I know in the insurance industry is a guy named Chris Jacobs' partner, Bob Schwartz. Really good engineered mind. And he looked at this and said, so let me get this straight. Over time, what if the appreciation is higher or lower on the home? How does that change this? So in this case, we've assumed 3% or 2%, but what if it was 0? What if it was 3? Well, what's the deal? The deal is that the Cornerstone, which is the CHEIFS product, they ride along with the risk. So they share in up to 50% of the future value of the home. If the growth was 0, let's look out 30 years, what would be the cost of funds return? Well, the cost of funds return would be 2.81% because Cornerstone is participating in the future risk or reward of home appreciation. Again, these clients are risk averse. So yeah, if it appreciates at 8% a year, then Cornerstone's going to make a lot higher return. Okay, so is the client and the client's estate. The real concern though is, yeah, but what if real estate goes upside down and there's no growth? What happens then? Well, again, this is a hedge. Cornerstone with their CHEIFS product has provided a hedge for risk-averse clients for long-term real estate growth that isn't what they hope it would otherwise be. So I think and anyway, the point is Bob Schwartz said, I don't think people are understanding that that's a very big deal, that this is a hedge, that's a big deal. And I agree. I think it's a wonderful additional attribute. And you can see it in black and white. Now, go back and make the appreciation rate 3%. And then you're going to see that Cornerstone gets paid a lot more money. Let's go back and look at it. And go to year 30. Okay, year 30. Yeah, it's a 5.9%. But you know what? 5.9% is an absolute barnstormer, world killer, game-changing cost to access liquidity that you don't have to repay back till someday when your home is sold and you're either deceased or moving to hospice care or nursing home care. That is a tremendous value proposition.
Hey, Craig, I've got a question, and it's probably on a lot of people's minds, but we thought of this and you answered it. Well, first of all, Don answered the question of what if my property value goes down, or what if a tornado wipes out my home and my homeowner's insurance, reimburses me X. The other one was, are there any limitations on what changes or material changes I can make to my house? And does Cornerstone go on the title or the deed?
So I'll answer those, Chris, in reverse order. So like a mortgage, a lien is filed, and that lien names Cornerstone Financing as an interested party in your home. So that at some point in the future, when your homeowner client decides to sell the house, the world knows that the sale proceeds, some of them will go to Cornerstone because we have a lien on the property, and the rest of the proceeds will go to the homeowner who owns the house. As far as deed is concerned, we don't go on the deed. This is your homeowner client's house. We don't have any effective ownership other than the fact that we have an interest in the property that is supported by a lien. We structured CHEIFS, as I mentioned before, to give homeowners the most amount of flexibility that they want. And Don said something before that was really important. You know, we limit the amount of ownership percentage that we'll take to 50%. We do that because we want our homeowner partner to have a lot of skin in the game. That usually leads to better outcomes when it comes to longer term home price appreciation. In that vein, if someone wants to put an addition to the house, you know, they've got $1 million house and they want to put a $300,000 addition, we give full credit to the consumer or the homeowner for that addition. In other words, our equity share percentage will decrease because the value of the property has increased absent of home price appreciation or depreciation. So it's a full-blown incentive for homeowners to improve the property as much as they want. They'll benefit from it. And then,
Great.
Chris,
Go ahead.
your first question, I don't quite remember it.
Oh, you answered it basically, and I think Don answered it. Is, you know, what if a tornado or something wipes out the home?
Let me
And my
let me
home,
tell everybody that. I'm sorry, Chris. Go ahead. I apologize.
my home was $2 million, but I got reimbursed by the insurance company $1.8 million.
So again, like any kind of mortgage transaction, homeowners insurance is required, and we would participate in some of the proceeds from the homeowners insurance in the event that the homeowners insurance proceeds were not used to rebuild the house, which is typically what would happen. If the house was rebuilt, well, then we just keep going.
Got it.
So I'm going to say a couple of things that are probably going to get me in trouble, but everybody knows me well enough. I just don't care. And I've never cared. So let me say a couple of things. Okay, first of all, if this product had come out 20 years ago, it would be really hard to explain to clients. But you know what? You know who's been spending 20 years explaining exactly how Cornerstone works? The reverse mortgage guys for 25 years. So clients all understand reverse mortgages. They've all looked at them. Most of the mass affluent and high net worth won't do them because the costs are too high and they just don't need the money that bad to even if the kids are going to pay, you know, because it's not, you don't have to pay the reverse mortgage back. It's like, oh God, this is so expensive. I don't need the money that bad. I don't need the money at all. So my point is explaining Cornerstone, explaining the CHEIFS product is they've done 25 years of education to explain how these structures work where you don't have to pay. Of course, it's not a reverse mortgage. It's not what I'm saying. What I'm saying is all of the conditions that apply to a reverse mortgage, or most of them, are exactly what's going on here. So yeah, you have to pay the property tax, and yeah, you have to have insurance and all the things. And most clients already know how reverse mortgages work, so they're going to very quickly understand how the structure works. That's first. Second, yes, reverse mortgages are very hard to sell because the costs are so darn high. This is not going to be hard to sell because the costs are so low. And on that point, for a long-term forever home clients, for sure, Craig, can you explain sort of the typical process of, you know, a homeowner calls, yeah, I want to do this. How long does it do? What's involved? How long does it take? Give us the gist.
So Don, the easy answer is typically 2 to 4 weeks. So if
And
an advisor,
what happens during that time?
So an advisor refers over to us their homeowner client. And at that point, we provide them with a quote estimate. You know, they tell us how much they think their house is worth. They tell us if there's any mortgage debt on it. And we give them a sense as to how much money they could possibly get.
Okay.
Once they decide they want to move forward, an application is taken. We do an appraisal. We order title insurance. We close. We fund in 2 to 4 weeks. That's it.
All right. And so this is the part that I got to be careful. So premium financing. Okay. I'm going to be real careful here, not to make anybody mad. Premium financing was created to provide bank funding for a number of different types of life insurance contracts. So whether those were ways of boosting retirement income or estate planning or what have you. The part I'm trying to get to is premium financing is complicated. It's hard to explain. There's a very narrow group of customers that have the wherewithal on collateral and to have advisors to understand, gee, what happens if interest rates go up and down? How does that impact the collateral? And what's the fine print on the lender contracts? And is it really recourse or not? It's really not recourse, but it kind of is. I understand premium financing really well. What I would never say is that it's easy to explain. I don't think that's that controversial. It's extremely complicated. Why am I talking about premium financing? Because everybody, this is premium financing 2.0, meaning it's not premium financing, but it's a way to create liquidity for insurance, financial products, other types of planning. The difference is, instead of being complicated and hard to explain, it's simple and easy to explain. And instead of there being 1 out of 100 clients where it's suitable, it's 25 out of 100 clients where it's suitable, because there's going to be a correlation between clients that have financial advisors and clients that are older with homes that have tremendous amounts of equity in them. So I just see this as a tremendous opportunity, far greater than the opportunity that we've seen over the last 20 years with premium financing, which I think we would all agree, created a lot of exciting cases. These maybe clearly are not as large as those cases, but they're a lot easier to explain, a lot easier to get done. And there's a lot more clients that are suitable. So there, I don't think I was too controversial with that.
Not at all, Don.
CHEIFS puts out some great, I'll call it marketing material. There's a very handy advisor guide that they have that explains all this. The presentation for clients. And you guys recently had an article in what was the magazine that this was in?
That's the Aspire magazine from Libra.
Aspire magazine. So maybe InsMark can make some of these things available or send them out to the people who are on the line. I think I don't know where you go to find them, but I know that I've got them.
Yeah. So Tony, a couple things. One is I want every single person that either signed up or attended, whether they attended or not, don't care. I want a recording of today's presentation to go to everybody listening. That'll happen in the next couple of days. They got to process it, and I don't know what they have to do, but you should get it in the next couple of days. In addition to the recording, I want everybody to get Tony states, I want everybody to get this thing we're looking at, this periodical or article or whatever it is.
You got it.
Just include that.
Advisor guide. Yep.
Yeah. And work with Chris Jacobs or Craig so we can get this.
We can help you.
I'm sorry. Go ahead, Chris. I'm sorry. Or Craig.
Yeah, I was gonna say, Tony, we can help you with all this.
Perfect.
Okay.
Thank you.
And then, Tony, I want to share my screen again, but I know I screw this up most of the time. Can I share my screen?
Yes, you can. Go for it.
Okay. Now, when we talk about using wealthy and wise, scenario 1 is just keep going the way you're going. Scenario 2 is using CHEIFS funding for any of these, LIRBs, mutual funds, annuities, and so on. I think you're kind of seeing this might make a little more sense now, right? And then we can compare the different reports, annual cash flow that we looked at, it was being able to fund the retirement income they wanted, liquidity, how does the liquidity change? What is the net worth? What happens with that? These are different reports you can show. What's the estate value? What's the net to heirs after paying the pension tax on the pension or whatever it is? And then I want you to take the screen away from me, Tony. And then we're going to do some questions and answers, but give it back to Chris and have Chris show the summary graph we started with, just to kind of do full circle.
Okay. Am I back up and running?
Yeah.
Yes.
Okay, great. So notice these are the scenarios, but the real power in InsMark is the comparison of do it versus don't do it. And that's what is happening here. So if I just hit preview, first thing that's going to pop up is that PDF chart that you looked at in the beginning. And, picture's worth 1,000 words. if you can have the same income, but have $2.4 million more of liquidity, use and control of money, uh, what is the reason not to do it? Because you don't know what's there. So I think just from a moral obligation, almost, you've got to be able to talk to clients about this and let them know that they can free up a dormant asset in order to provide a better standard of living, more safety and comfort, long-term care. There's a whole host of things, but especially in this Roth conversion realm, how much is in qualified plans that hasn't been taxed before, Don? Was it you who said it or Craig?
Craig. Craig said that only, well, 3% of all qualified plan dollars, only
But it's
3% have been
It's
converted to
like
Roth.
40 trillion dollars. So that's a pretty target-rich audience out there. And the other thing is, when you think about a HELOC, and what is it, 62? Craig, is there any age limitation on doing a Chiefs plan?
No, so there's no age limitation, and Chris, you're absolutely right. I mean, the $40 trillion, total addressable market for Roth eligible conversions, kind of strikes up nicely with the $35 trillion in dormant home equity that's out there. It's
Yep.
interesting that those two come together nicely.
Yep, it's a huge opportunity. That's all there is to it.
All right, so let's do a question and answer. All right, so I'm just going to go through these one at a time. I'm going to read the question aloud, and then whoever wants to answer it can answer it. Okay, so can we get the Chris Jacob workbook, what we're looking at on the screen right now? Can we include, Chris, your workbook when we send out the recording of your webinar? Are you
I'll
okay
actually
with
do
that?
the workbook, and I made two presentations that I'll have in PDF format. One on the 150,000 of do it versus don't do it, the Roth conversion status quo using equities, and the Roth conversion Chiefs. It'll all be in here. Plus, you'll have the PDFs to this.
And let me just say, for those of you new to Wealthy and Wise, like workbook, what are you talking about? Okay, so the way it works is that when you create a case with Wealthy and Wise, you can go up to that top left corner where it says Client Workbook. Click on that way at the very top, very, very top there. You can go on that, and then don't do this. I just want to show them. And then you can export a workbook, or you can import it. Well, export a workbook, all it does is it creates a file that you can store on your hard drive in your computer, and then you can email that file. And then when someone else gets that file who has Wealthy and Wise, then all they have to do is download the file, double click on it, and it automatically brings this case that Chris created into your Wealthy and Wise software. So it's really efficient to collaborate with other Wealthy and Wise users like Chris. When you're building cases, you can share workbook files and instantly get the case that they've built. So that's all.
Yeah, and you can kind of use this as a template once you import it, because if you go into cases and you hit open, you can go to this one and you can hit copy, okay? And then make a new one, but it's going to be a clone of this one, and then you can adjust the inputs.
Yeah, and just so everybody knows, we're coming up on a hard on the hour, but we're going to keep going. We're going to keep answering questions.
Hey, Don,
So
do you mind if I just explain what this button is here?
oh my gosh, no, please, let's spend some time on Repredict. But please,
Okay.
you guys, real quick, we're going to show you the Repredict platform, which is an incredible accompaniment to Wealthy and Wise and all of InsMark software products. Chris, please show them this before we get into the question and answers, please.
If you hit that Repredict button, it will take you here. Or you can just go to repredict.com. And what is Repredict? It's me and my partner, Bob Strauss, who's taken a vacation, I think, for the first time in 3 years. He's the brains behind this thing. Created and got a patent in October of 2023 on an AI-assisted prediction spreadsheet. And if you click that button right there, we were actually got an award for it, but this is going to explain how it works. But I think Don summed it up very succinctly. Repredict is a powerful artificial intelligence platform that increases efficiency and effectiveness for producers. What used to take 15 to 30 minutes per change now only takes 15 to 30 seconds. we're not going to make this a dissertation on Repredict. Okay.
Yeah, watch this, everybody. You're gonna be amazed. Go ahead, Chris.
So I imported, and as long as you got a PDF or an Excel file of an illustration, you can import it in here, and Repredict cleans it up. So this is just a typical LERP where somebody's putting in 100 grand a year. It's a 45-year-old and projected to start generating tax-free loans at 244,000. You've got the illustration, you're sitting in front of the client, invariably what happens? Well, I don't know that I want to spend $100,000. What would this look like if I just spent 70? Okay, so I'm going to go to this predict button here. If you're really lazy, you can hold this button down and talk to it. But all I'm going to do in this case is change this to 70,000 and hit quick predict. Boom, there's your new illustration. If you go back and put those premiums in the company software, these numbers will be 99% accurate. Okay.
And I promise you that's true. Don't worry about the accuracy. It's dead on accurate.
It doesn't matter what company you use. It doesn't matter whether it's variable universal life, indexed universal life, whole life. It works with anything. All right.
Yep.
That's the genius of my partner, Bob. Another thing that you could do, let's do another prediction real quick, is that, and this is tough to do in company software, and the person says, yeah, what would this take if I wanted $300,000 of income coming? Can you run that for me? Yeah, let me go back to the office. We'll get together next week. Not here. Boom. There you go. Put those premiums in the company software, and you will come up, like I said, 99%. So the best way to learn more on Repredict is just to hit the button in InsMark or go to repredict.com. You can schedule a demo, and that's what we got to Repredict.
Let me just say a little bit about Repredict. So, InsMark doesn't do the actuarial numbers. It doesn't do the carrier illustration. What Repredict does is when you bring over the PDF and the numbers, by using AI, it automatically understands all the actuarial underpinning behind how that was built by the actuaries at whatever insurance company you're using. And then you can literally change anything on this page, and it will automatically know what all the other numbers should be, and it does it instantly. You don't have to go back to the carrier solver and figure out, okay, but I have to do this and do that, and it's 20 minutes later or an hour later or never, or call the home office. You just change whatever you want. It automatically changes everything perfectly actuarially correctly.
And by the way, I forgot the most important
please
button.
Go ahead, Chris.
See this button here? And you know how difficult it is. Some carriers don't have the button file for InsMark. Other carriers lock out their illustrations so you can't even copy and paste the numbers into it. This will bring in any carrier illustration, no matter how hardwired it is to keep you out of copying and paste it. And the ones in here, you can even export it to a CSV file and use it in your own software. But more importantly, once you get it in here, all we have to do is hit transfer to InsMark, boom, send to InsMark, and now it's in the InsMark data file that can be used in any one of the modules.
Yeah, then it comes over to our platform.
Yeah, and you can do that on the prediction too. It's right there. Boom, there you go.
Yeah, so it's not only does two things. Repredict makes it unbelievably efficient and fast to make changes based on what the client, how they react. Oh, I want to have more income, or I want to pay for 5 years, not 10, or whatever it is. But the other thing it does, and this is important, is sometimes you'll want to make changes and you can't do it with a particular carrier software. It just won't let you do it. And so it's not that it won't let you do it. It's the 4 hours you spend trying to figure out and learn that it won't let you do it. Because I've run a lot of proposals, and it's like 2 hours later, I'm like, oh, okay, so it actually won't do that. Great. Or you call the home office and leave a message, and 3 days later, you get a call back, and you miss their call, and you got to call back, and you're trying to figure out, how to add. Oh, that's gone. And once you bring the case over here, you can do it. You literally can make whatever change you want, and it automatically will change everything else and be, it's 99.9% accurate if you go back to the home office proposal and replicate what they're doing in Repredict. So again, this was one of those things. It was like Cornerstone. When these guys, Chris and Bob at Repredict showed me this, it was literally, how long did it take me to get this Chris, about
I
it
kept,
being
that sounds like, okay, I get to
just
stop. I'm like, but I haven't shown you everything.
like, oh wow.
It's called selling beyond the sale.
Well, it's just so valuable for case designers and people trying to,
And I would be remiss if I didn't mention one more thing. Well, what
sure.
about the dreaded in-force illustration? That's always wrong.
Yes,
2 weeks to get.
yes.
You can upload the original as sold illustration in here. Let's say it's year 4 and the person comes in and says, well, I just got my statement and it's not the 320, you know? I tell people
Yep.
there's only going to be 2 columns that are correct going forward. This one that says age and this one that says year. He says, I got $300,000 in here. What's this going to look like? Now I hit predict forward because these have already changed. And based upon the original illustration assumptions, this is going to then go forward and change this down here. It's a game changer for in-force ledgers.
It is. It absolutely is. So thank you, Chris. I'm so sorry I'm
No, that's all right.
totally,
We still got
I'm
time.
really glad we covered that. Repredict is a great platform for everything he just explained. All right, moving into questions. Okay, that's a good question. So Howard asks, what does the I stand for in Chiefs? Craig?
So, Don, I was, while you and Chris were speaking, I was answering a few of these questions real time. So,
Okay.
so Cornerstone Home Equity Insurance and Investment Funding Solutions. There are the 2 I's.
All right, I see it. I see it now. Thank you. Okay. Okay. So the question is, why does the interest rate on Chiefs say 12.99%? You were saying the APR is less. And again, it's because the return to Cornerstone on the Chiefs advance is limited to 50% of the future value of the home. So that is going to be less than the 12.99% in future years. Okay. Elizabeth asks, and again, we're probably going to go another 10 or 15 minutes. We certainly understand if anyone needs to leave, but we'll just keep answering questions. So Elizabeth asks, so it's not applicable to rental commercial investment property owned, Craig?
That's correct. Could be your primary residence. You could have 4, vacation properties that you and your family spend time at. You can do a Chiefs on all of them.
Okay, so Steve asks, so this is very similar to HomeTap and many other home equity, private equity companies granting access to tied up equity. Craig?
Don, may I answer that question?
Craig, please.
So,
Yeah.
HomeTap and a few other institutions have come out with equity sharing, appreciation sharing products that were intended to compete with the reverse mortgage demographic. And the terms of those products reflect it. Typically, they'll have an interest rate cap that's near 20%. They'll have origination fees that are around 5%. When you compare and contrast that to Chiefs, it's stark. Chiefs are roughly 700 basis points, if not more, cheaper on an annualized basis versus these other products. And the origination fee is a third of the origination fee that these other institutions charge. Those products are intended for people who are poor credits, subprime type of consumers who really are looking to either sell their house or just get whatever money they can get. Our product, and I think, Don, you said this really well earlier, it's intended for A clients, and A clients need A-level terms in their financing.
Yeah, understood. Yeah. There's lots of home equity products out there. They're just for people desperate for liquidity. They're payday loans in the home equity space.
That's right. And the terms reflect it.
And the terms reflect it, and the cost of funds reflect it. So, yeah. So, question for in the case we looked at, the client borrows, and it's not a loan, but there's a partial sale advance from Cornerstone of $326,000 in the case we looked at, and then has to pay back $1.1 million. I'm assuming in 20 years or what have you. When they sell the house in 20 years? The answer is yes. And again, that works out to a 6% cost of funds. So 20 years is a long time. the 326 is going to grow to a fairly large number, but clients are going to look at cost of funds. They're not going to look at total repayment back, or no one in the history of the world would have ever done a 30-year mortgage. Because obviously, if you look at the money you pay back on a 30-year mortgage, it's a lot, but still a good deal for the client. Okay, so of course, yeah, this is all assuming the house doesn't depreciate. No, if the house depreciates in value, Cornerstone rides along with that risk. They're still capped at 50% of the value of the home, which is, I think, one of the best features of the plan. Okay. This is a question. I'm not sure I understand the question. Assuming PE, and I'm not sure what he means by PE, assuming PE is financing this, if they change their mind or something or anything, is the homeowner partner affected, or do the terms all stay the same no matter what private equity does? Oh, assuming private equity is financing this. Craig, comments?
Yeah, so Don, let me jump in there. Cornerstone was fortunate enough to strike a strategic relationship with an investment firm called Fortress, who have agreed to purchase $1 billion of CHEIFS over the next 2 years. So $1 billion. That's a really very, very powerful commitment, which gives, we believe, advisors like yourselves and institutions that we're working with a lot of confidence that they can allocate resources to utilizing CHEIFS as part of their financial planning and know that the money's going to be there.
Yeah, I mean, the way I look at it is the client has Cornerstone's money. So, again, if this isn't just Cornerstone, but if someone advances me 326 grand, I'm not too worried about them going out of business. Whoever takes over their portfolio is going to call me and want me to pay them. It's not like it's not the risk that I give somebody money and now, they go out of business. Well, that's a real risk because then I might not get my money back. But this is a little bit different because the advance is going to the client. So I just don't, the future repayment to Cornerstone or whoever someday that is, I just don't see that as a risk to the client. Is that you follow?
Right.
Yeah. Okay. So let's look at. Okay.
Hey, Don, I forgot to cover one thing.
Yeah, go ahead, Chris. You're good. You're good.
Somebody wanted to know how much Repredict was. It's this.
Oh.
Okay. And you can even get the free trial. I would sign up for a demo first, though.
Great. $49.95 per month. And that's great. And then, this is a good question from Will Hansen. Go in and change the appreciation rate to 6%. Let's see how much money. Change it. Go back. Okay. And change growth to 6. And now let's see what the APR is in year 30. Let's say. Let's see. APR. Yeah, it's about 9%. So yeah, everybody wins. It's a partnership, I guess, and not technically, but everyone is sharing if the growth is higher. And I think that's fair because everybody's sharing if the house depreciates.
Hey, Don?
Yes, David.
Yeah, we've got a number of questions on the pricing of Wealthy and Wise Plus. Would like to explain how that works. One question was, does that monthly fee ever end? That kind of a thing. So if you could explain the no upfront fee and such now.
Yeah, just contact Julie in the area at InsMark, and we'll put up. David, can you tell Julie's phone number?
Yeah, Julie's phone number is 925-543-0514. Julie can answer all the questions for you, but just initially.
Yeah, let me explain the pricing.
Yeah, please do, Don. Thank you.
All right. So the way it works is it's normally $2,000 and $60, $59.95 a month. We'll call it $60 a month. For now, we're waiving the $2,000 fee. It's $60 a month as long as you want to use the software. If you stop paying the $60 a month, your Wealthy and Wise Plus software will no longer work. So I guess if you want it to keep working, the $60 a month is forever. Like, your cable bill. And in addition to that, if you terminate and you want to come back on, then we will have the $2,000 fee. So if you terminate, just make sure you don't want to use it in the future, because if you once you're a Wealthy and Wise Plus user with a waived fee, if you then terminate in the future and want to come back on, then we will charge you that $2,000 fee that we're waiving now. So that's how it works. And I don't know, we got a couple $1 million in development.
Don, let me add,
David, real quick, we've got a couple $1 million, at least maybe $3 million in development of this. $60 a month, it seems like a pretty fair trade. Go ahead.
Yeah, no, extremely fair trade. And wanted to add that on the for the people that currently on this call or anywhere in the country that have Wealthy and Wise, which there's thousands and thousands of you, you've already received the Wealthy and Wise Plus upgrade, and we did that for free. We did not charge our current users of Wealthy and Wise additional to get the Wealthy and Wise Plus, which has the CHEIFS integration in it. That was one of the questions that came up. So again, if you didn't realize you have CHEIFS integration and you're on this call, you do right now, and you're seeing what Chris did, you can just go into your software and start doing, go through the CHEIFS program yourself. Okay.
Thank you, David. This one's for you, Craig. Jumped on late, but please address the HERA Act and the CFPB regulations around bundling reverse mortgage funds and annuities together.
So let me take those in order, Don. So the Housing and Economic Recovery Act of 2008 was done to make sure two things occur with respect to reverse mortgages. One is that a reverse mortgage is not conditioned on the sale of an annuity or something like that. In other words, they're tied. And secondarily, that the advisor doesn't get paid on both transactions, the reverse mortgage and the annuity sale or the life insurance sale. So I'll start with this. CHEIFS are not reverse mortgages, which means we're out of this already. But more importantly, we do not tie the sale of CHEIFS to any specific insurance or investment product. At the end of the day, the homeowner can do whatever they want with the proceeds. That's the critical thing. And secondarily, Cornerstone does not pay the advisor for the referral of CHEIFS. Likewise, unlike premium financing transactions, we also don't take a piece of the commission that might be generated from us funding an insurance policy. It's kept separate. And we've constructed the CHEIFS program to make sure that we remain in compliance with some of the things that have come out in the past, like the HERA Act of 2008. Don, the second question was around the CFPB?
Yes.
So the CFPB, for what it's worth, is hardly functioning these days. Most states regulate mortgage products, shared appreciation products, reverse mortgages, and CHEIFS. And depending on the state, it will drive how they look at the product. Some states don't require a license. Some states require a real estate license. Some states require, even though they're not mortgages, a mortgage license. But they are regulated at the state-by-state level. The CFPB has become effectively neutered over the last 12 months, so there's not much to talk about with respect to the CFPB.
All right. I think Michael had a really important comment. Michael Marshall's comment is beautiful. Thank you, Michael. That was nice. Okay, next one is, I love this question from Victor. How do we input this in Wealthy and Wise? And let me answer that. We're going to send you Chris's workbook file. You have to have Wealthy and Wise Plus, presumably. When we email you a copy of the recording, we're going to send you Chris's Wealthy and Wise workbook file. You're going to take that file and download it to your hard disk, put it in a folder. You're going to double click on it, or you can do the fancy way where you import it, but I just double click on it. It'll automatically load into your Wealthy and Wise, and then you'll have the case and you can walk through every single tab and see exactly what he entered. You see every single thing he did in these different tabs: preliminary data, desired cash flow, everything. You can just click through there and see everything he entered. And then you can click on the reports and run whatever reports you want, and you'll see exactly how to do it.
Yeah, and I would encourage you to make a copy of that I showed before, where you go into workbooks. Once you open this up, copy it so that you can keep this as a template. And
Yeah,
then
go
you
ahead and Chris, show that if you don't mind. That's a great idea.
So if you've imported this and now you go to open, and it's going to have all your case files in here. Here's that one.
Yeah.
All I now do is hit copy, and I'll just say COPYCHIFS. Boom. Now I've got the copy in here. That one's saved for me. And now I open this up. It's a clone, but now you can go in and you can change the client data, all that good stuff.
Robert Green, Robert, he says, I have to run. Wonderful presentation, Robert. Great to hear from you. Hope you're doing well. Okay, reading through questions. Okay. All right, and some of these I'm not, because we've answered them. So please understand, everybody, I'm not ignoring your questions, but I'm not covering the same questions over. Okay. Okay. Just looking. HELOCs are expensive, last I knew. Yes, Elizabeth, you're absolutely right. HELOCs are expensive, and they're really not competitive because you got to pay all the money back during retirement. So that's for a 5 or 10-year need for liquidity. It isn't a long-term solution like this is, and like reverse mortgages are, albeit with higher costs. Okay. Is that Howard asked? That's a great question, Howard. Is there a date the Wealthy Wise software initial $2,000 fee will come back and won't be waived? There's not. I haven't made up my mind on that. It's waived for now. I don't know when we're going to bring it back, but I don't have a date for it. Okay, so okay. Let me make one other comment. How many times can somebody do a CHEIFS transaction and get their home equity out of their home and redeploy it? Spend it on a new boat or buy an annuity or pay a Roth tax. How many times do they get to do that? Once. One time. Because the home equity is used for that purpose. So I guess what I'm trying to say to you is the sooner you can get to your clients, every single client you have over 50 should hear this story. They might not want to do it. They might say, well, we don't have that much home equity, or, we're not interested. But every single client over 50 that you have should hear this story and at least give them the opportunity to do it. Because if you don't, then other people are going to talk to them about this that compete with you. And that's, again, you're only going to get one chance at doing this. And then all of a sudden now they've built the relationship with someone else. And then that causes other potential competitive issues. So anyway, that's the reason to move forward, I think, more than avoiding the upfront fee. But I understand your question and appreciate it. I don't know when we're going to bring it back. I'm not sure. Okay. Will Wealthy Wise become internet portal based, or will stay software hard disk based? So right now, Wealthy Wise lives on your hard disk, and then we update it through the web. We are working on a web-based version of Wealthy Wise. Probably have something for you to look at end of the year. For that. Okay. Reading through questions, everybody. Okay. Again, the reason there's the pause is I'm seeing questions that we've already answered. Oh, this is a great question from Jonathan. If the client doesn't want to sell their home in 15 years after doing CHEIFS, presumably, but wants to pay off the CHEIFS advance, what is the amount due to CHEIFS?
Don, it's a great question. So
it is.
Client can unwind the CHEIFS transaction at any time. Let's just start with that. And there's no prepayment penalties.
Okay.
If they choose not to sell, we get an appraisal, and that appraised value acts as a proxy for a sale. And whatever percentage of the value of the property that we're entitled to based off of the appraised value.
Got it.
Very simple.
And then it's a lesser of column 3 or column 4.
That's exactly right, Don.
12.99 or the 50% of the value of the home, or whatever the percentage you work out. Okay. Fine. Okay. Elizabeth says, if we use your software, we don't necessarily make money. Given this, would you consider, revenue share on product sales? No, we wouldn't. At $60 a month, you don't want to share your case commissions with us. I mean, you do one case, you're going to pay for the software for 5 years. So,
That's right.
so no, that's not something we would do. Okay. Let's see here. Moving on. Okay. Okay. This question again, the regulation issues. Great. Okay. Okay. I love this question from Howard. What are the drawbacks to Chiefs? Can I take a run at that, Craig, real quick?
Go for it, Don, and then I'm going to compliment you.
Okay. There are drawbacks to Chiefs for sure. One drawback is it's not a great deal if you have a short-term liquidity need. Look at the cost on column 6. People who are high net worth or mass affluent probably are better off in a short term going and getting a HELOC because they can qualify for it and it's a short term need for money. So if you have a single client that's in bad health, less than a 5-year life or 10-year life expectancy, that they shouldn't do Chiefs. If you have clients that are like, well, we really don't like living in Alamo anymore. It's changed so much and our kids are all in Hawaii. We're probably going to move in the next 5 years. Not a Chiefs customer.
Right.
They're not. So again, you want someone in their forever home, relatively husband or wife, relatively healthy, meaning they don't have a 5-year life expectancy, because then again, not a great cost of funds profile. What else? I don't know, Craig. What else?
Don, it's exactly what I was going to say. We said it early on, and you've repeated it multiple times, and that is, if you're looking for intermediate to long-term funding, Chiefs is really efficient. But if you're looking to do something for 2, 3, 4 years, I wouldn't recommend Chiefs.
Yes, go get a HELOC. Pay the money.
Exactly.
Yeah,
Hey,
be
guys.
done with it.
I'm going to have to run, but I'm just going to put this out there. And if InsMark would sponsor it, I'd be happy to show up. I mean, we didn't get into seeing how the watch was made today. Didn't have time.
Yes, that's right.
But at some point in the future, if you get enough, interest, I'd be happy to show how we start one of these things from scratch, okay, and put it together.
More of a Wealthy and Wise tutorial.
Yeah,
webinar. Yeah, I love it, Chris. I would love to do that, of course.
Okay. All right, guys. Thanks so much. Feel privileged.
All right, Chris. We'll stay on. Thank you, Chris. We'll stay on for another minute or two. I just we're going to end it on the half hour. Just looking very quickly. If we missed anything? Okay. Oh boy, we got through all the questions, and it's 27 minutes past the hour, so we did pretty good.
Don, there was one more question that came
Go
in.
Go ahead.
From Jonathan Moulton.
Great.
Regarding, I believe it said something about what if you have a house with a $600,000 mortgage on it, but it's worth $3 million. How much Chiefs money can you get in a situation like that?
Craig?
I'm actually doing the math right now, gentlemen. So 30% on 3 million.
The answer is you can do it even if there's existing liens.
It's roughly like $225,000.
Okay.
In fact, Don, or it's a shame Chris is not there. We could have gone back into Wealthy and Wise Plus
and
put in a $3 million house, $600,000 mortgage, and actually show it.
Yeah, so it'll automatically calculate that in Wealthy Wise. Now we have, in our remaining 2 minutes, let's get to the most important thing, which is, I think Craig had a compliment for me.
No, so you nailed the drawbacks to Chiefs. Nailed it.
Oh, okay. Hey, everybody, thanks for being. Craig, anything else before I wrap it up?
Don, what I was going to say is, we talked a lot about home equity and Repredict as game changers. We think in our space, having a point of sale tool like Wealthy and Wise Plus, where home equity is integrated into other funding sources like AUM liquidation or just going to your bank account and using money and being able to compare all of those things side by side, we think that is a game changer.
Yeah, I do too.
And Don, may I add one last thing, Don?
Yes.
from a marketing standpoint from InsMark, we'll be reaching out to several million advisors and the various roles they have out there in the industry, doesn't, life insurance agent and so on. You will hear from us a lot on Wealthy and Wise Plus.
Correct.
Because Wealthy and Plus doesn't just do Chiefs transactions. It's been around a long time, and you do a lot of work with Wealthy and Wise in itself. So with the Chiefs thing, you will be hearing an awful lot over this time, and there's $1 billion in funding that's a premium dollar sitting there, and it's a race to the top. And we look forward to working with anybody that does subscribe to Wealthy and Wise Plus and does some Chiefs transactions.
Yeah, you're referring to the $1 billion that was just committed by Fortress.
Correct.
To Cornerstone. Yes. Agreed. Thank you, David. For everybody here attending today, thank you so much for spending some time with us. We are super excited about this. We'll see you next time. Thanks, everybody.
Thanks, everyone.
Thanks, everybody.